Okay, everybody on Zoom, give us a couple more minutes and then we'll get everything started. I think we have a couple of people that might be joining on, and so give us a few and then we'll get started. It's about 10:57. We'll try to get started right at about 11 o'clock. Not a super long class today, but lots of good information that I wanted to make sure and cover and go over so you guys have a good understanding of things. I'm gonna grab a couple of things off the printer. Be right back. Yeah. You're welcome. Okay, guys, just another minute or so. I know Talina's out in the hallway on a phone call. I think she's going to come in for the class too. Just probably just a couple minutes and then we'll get started. Yeah, we're just gonna get one. Only if you're, I didn't want to start until you were coming in. Okay, good. Didn't want to rush when she had enough time for your call.
Working out more cruises.
Yeah, total fun. Okay. All right, everybody, good morning still. I think it's almost afternoon, but good morning. Thanks again for coming to this class today. Got lots of good information to kind of go over and discuss. Probably won't be a super long class, but I mean, I have a lot of good information to kind of go over. So we can take as much time as we need and go over any kind of examples or scenarios, anything like that. But everybody that's on Zoom too as well, thank you for joining. My name is Cliff Cox. I'm the senior loan officer here with Cross Country Mortgage. And my goal today was really to put a good focus on, down payment amount requirements, seller concessions, all those kinds of things. Because even today, I still get lots of phone calls to see how much seller concessions, a buyer can get on what type of product, all those kinds of details. And so I just think it's important to have a good understanding of each thing and each option for each particular product on how much concessions can be done and depending upon all these kinds of things. So I just wanted to make sure and kind of put the focus on that today. And if you guys have any questions or anything like that, definitely stop me and let me know. Everybody that's on Zoom, can you see my screen? I shared my screen. I just wanted to make sure that you guys can see it. Everybody good?
Yes.
Okay, perfect. Okay, thank you, Kamarsha. I just want to make sure this was visible. Okay. All right, guys. So what we're going to talk about first is we're going to go over each product. The products that I focused on today were just conventional loans, FHA loans, VA loans, and USDA loans. I'm going to kind of get into some non-QM loans as well. But just wanted to kind of go over what the minimum requirements are for these types of products. And then, just so you guys had a good understanding of what we're going over and what you guys need to know when making offers and, getting buyers structured accordingly. So for conventional loans, the minimum loan amount requirements, for first-time home buyer programs that are available are 3 to 5%. Those are pretty much across the board. So if a buyer can qualify for, the 3 to 5% down first-time home buyer programs, they absolutely, can put as little amount as that. Now, if it's not a first-time home buyer, the minimum amount down is still only 5%. They just can't do the 3%. So one of the buyers on that transaction, in order to put 3% down, has to be a first-time home buyer. They don't both have to be, it just has to be one. So if you've got a couple that is buying a house together and, one of them, purchased a house, 2 years ago and is getting ready to sell it, but the other one is a first-time home buyer, you can still qualify for that because it just has to be one. Okay. So just wanted to give you some good information real quick on that. So next we're going to talk about, if it's a single family residence or a multi-family property. Now this is what's nice and new too that has changed. And this just took place last year. So typically when a person is buying a property, if it's a single family primary residence, you can put as little as 3 to 5% down. But now if it's a multifamily conventional, so as long as it's a primary residence and they are living in the property, they can potentially put as little as 5% down now on a conventional loan. Before it was minimum 20%. Minimum 20 to 25% on what they could qualify for, even if it was a primary residence. So now it only has to be 5% down as long as they're making it a primary and they are living in one of the units. So great news, great information on that, especially if it's a client that is maybe looking to possibly get into, the investment property game, if they're looking to say here in a few years, they want to turn that property into a full-time investment property. So the number one rule of thumb is if you purchase it as a primary residence, you have to live in that property for at least a year. Okay. So if they wanted to then turn it into an investment property after the fact, they most certainly can, but they have to live in the property for at least a full year before they can even, do those kinds of things.
Does that apply if like they're gonna live in one unit?
Correct.
So considered multifamily?
That's correct.
Okay.
Yep. Yeah, that's exactly correct. For example, I had a client just this was about 2 months ago that purchased a 3-unit property. And what happened was he wanted to know if he had to go FHA, because FHA, 1 to 4 unit, you can still put the 3.5% down. I was like, well, no, you can actually go conventional if you want to too, because the seller was really only wanted to take, if they could, conventional offers or cash on this particular property. So we got him approved for the 5% down purchase, since he was planning on, he was making one of those units his primary to live in. And we got it done relatively quickly. Yep. So yeah, good questions. Anybody that's on Zoom, feel free to, unmute, just start talking and let me know if you guys have any questions. All right. So that's good, exciting news, especially when it comes to, down payments and everything for conventional loans. All right. So next, we are going to move on to FHA loans. I'm sure a lot of you guys are pretty familiar with FHA loans, but I wanted to at least, put a little bit of good information on there, just to kind of see, and just so you're aware of, because these kind of questions come up and are asked, pretty frequently as well. So FHA loans, the minimum requirement down is 3.5% down. Okay. Pretty standard, in the industry. Everybody that's approved to write an FHA loan, follows these particular requirements. But one of the bonuses about this, about FHA loans, which was prior to conventional loans, going this route too, is that it didn't matter if it was 1 to 4 unit property. You could put as little as 3.5% down, because it's primary residence only. That's the only thing they do. They don't do investment property transactions. So, but what I wanted to make sure that everybody kind of knew about FHA loans is, if you just put the minimum amount down, which is 3.5% on an FHA loan, the monthly PMI will be on that loan for the duration of the mortgage. So as long as they have that FHA loan, they will have the monthly PMI being associated with it until it's either refinanced or sold. But if a buyer decides to put money down, say they had a little bit more money and they wanted to put a little bit more money down, if they put at least 10% down, okay, and this is on a 30-year fixed, FHA loan, the monthly PMI will then fall off on the normal amortization schedule, about 11 years for the monthly PMI to go away. Okay, so just wanted to let you know that. And another update too, it will fall off in the same amount of time too, is if a borrower decides to do 15-year FHA loan. It won't stay on there for the duration. It's the only for the 30 years. So if it's a 15-year, FHA loan, the PMI will fall off. I think it's after 7 years. So just some quick, information about FHA loans, just in case people ask you about it. They're like, oh, am I going to have PMI on my FHA loan forever? Not in certain circumstances. It just depends on what situation they fall in. And they could always refinance out of that if they wanted to, if they start to get equity in the property and they want to try to lower their monthly payment and getting rid of that PMI. We can maybe take a look at maybe refinancing them into a conventional loan, if they're able to, qualify for it and get their scores up and all those kinds of things. So good information when it comes to that. Okay. All right. And VA loans, I wanted to spend a little bit of time on VA loans too, just because this is important. We're getting, I've always have done a lot of VA loans. I do love doing them. I appreciate what, the veterans, kind of do and everything that they go through. And this is just an added bonus for them to be able to qualify with the, all the different perks of a VA loan, for them to, be able to get in to see what they need to do for their family. So VA loans, I'm sure you guys have known that the minimum requirement down is none. If you don't have to, you get up to 100% financing on any kind of VA loan. And that's very similar to FHA. I know a lot of people didn't know this. They thought maybe it was only primary residence, single family only. That's not the case. They can get 100% financing up to 4 units as long as they live in one of the units. Okay, so that's another good piece of information that I wanted to make sure and let you guys know as well, that it's 1 to 4 units, 100% financing. And so that's pretty awesome. Okay. one of the key things that I wanted to focus on with VA loans, because most veterans, depending upon their situation, okay, will have to pay a VA funding fee unless they're at a certain percentage of disability. And what I mean by that is if you've got a veteran that is looking to purchase a property and they want to use their VA benefits, but they are not receiving any kind of VA disability from the VA administration, they can go 100% financing, but they will have to have a VA funding fee that will be financed into their loan. And as you can see on here, my chart for the first time use, for the first time a veteran has ever used his VA benefits, and he or she does not get VA benefits in regards to income, their VA funding fee will be based on 2.15% of the purchase price. So a 200, if it's a $100,000 loan amount and the VA funding fee is 2.15, that would be what, about 2,100, 2,150 would be their VA funding fee that gets financed into their loan. So if their loan amount is 100,000, their loan amount will now be 102,005 or 150. Okay. I mean, they absolutely can pay that if they want to. If they don't want to have that rolled in or financed into their situation, they can absolutely pay that and not increase their loan amount if they're, conscientious of where they want their payment to be and what their loan size to be. They can absolutely pay that out of pocket. But I would say 9 out of 10 times when we're doing these for the veterans, we just finance it in. But another key thing is, and this was pretty good. This is I got a deal, just because I knew this information from another lender. The borrower had a little bit of money to put down, but wasn't sure if they wanted to use any at all or not. And the lender that they were working with told them that, hey, you just need to do 100% financing, and here's your VA funding fee. Let's just try to get this done and we'll get you closed, because I think they were just focusing on having the higher loan amount, because the higher the loan amount, whatever, that particular company or the borrower or the loan officer, makes commission off of the certain loan sizes. Sometimes that's not what's best for the borrower. Is what we make. You know what I mean? We have to keep the buyer and everything as far as the situation, to see what's best for them. So what I did was I knew that, because this was a pretty decent sized loan amount. So I think my loan amount for this particular option was about 350,000, I think, was the loan size for this VA loan. And the VA funding fee was a big chunk. You're talking 2.15% of a VA funding fee. That's a pretty bit. No, I'm sorry. This was even more, because he had a VA loan before. His was the 3.3. So, because after you use your VA benefits one time and it's your second time using it, and you want to go 100% financing and you don't get any VA benefits, 3.3% is what the VA funding fee is what you get charged. And this was like $12,000 based upon something crazy, because our loan size was so big. I'm like, look, how about you just put, maybe if you've got 5% to put down, this will really help on your VA funding fee, and you're not having to pay that money and get everything done. It was as simple as that, as me explaining, if he wanted to put 5% down, how this would cut his VA funding fee in half. And I literally got the loan because I explained that to him that way, and didn't push him to do the 100% financing just because he could. And it was an easy deal. We got it done in, I think this particular VA loan, I think we got it done in less than 30 days. So, and it would have been faster if we weren't waiting on, the VA for, some of the turnaround times and the appraisal and all those kinds of things to come in. But great information. And it's all about just educating the borrower on their situation. So next here, though, if it's their first use and they are putting 5% down, like I mentioned, it's only 1.5% for the VA funding fee. And if they're putting 10% or more down, it's only 1.25%. So great information. And then after, their first use, if they're getting a second VA loan and using their benefits after they get reinstated, 3.3 is the VA funding fee amount if they don't receive VA benefits. 5% down or more, 1.5% for the funding fee. 10% down or more is 1.25%. So good information. The sweet spot when it comes to if a veteran has to pay for the VA funding fee or not is if they get 25% or more disability from the VA. Okay, so when I reach out to them and I'm like, do you receive any benefits? Mr. Smith. And they say, yes, Cliff, I am 35% disabled. Here's my VA certification. This is what I get. They could be completely exempt from paying that funding fee altogether. So, but normally when we order their certificate of eligibility, it'll say right on there, like we go to the VA's website, we put in their social security number and their name and everything, and they'll send us their certificate of eligibility, which basically explains what their VA benefits are. And if they used them before, if they have had a VA home before that was possibly foreclosed on and they need to get their full benefits reinstated, and we'll help them go through that process, all those kinds of things. All that information is given to us once we order that certificate of eligibility. So, and it'll tell us on there if they're exempt or not from the funding fee. So good information. All right, let me see, make sure, any questions at all let me make sure I'm not missing anything in the messages, chat. Okay. All right, everybody good so far? Okay. All right. Yes.
So what is the benefit of putting 5% down? Is it a lower interest rate or is it just because of the PMI?
Yeah, the benefit for them would be, I mean, the interest rate for the most part should be pretty comparable, whether they're putting 5% down or doing 100% financing or 5% down. We're going to make sure that they get premium pricing, even depending upon their situation. The benefit is the funding fee. So if it's a certain loan size, if they've got 5% down, and they're planning on it anyway, they don't have to pay all of that VA funding fee. That's really the specific. Yeah, as opposed to conventional where they're going to have monthly PMI, because VA loans don't have PMI. So you could put 100% financing, no PMI. They just have the funding fee. So as opposed to conventional, that's a great question. If they put 5% down, that just really helps with that. But even on a conventional loan, you're going to have the monthly PMI unless you do a PMI kind of buyout. But that's another class. I'll go over that too on another time. But yes, good question. Okay. And then next, guys, I'm going to kind of get into USDA loans. I know these are frequent, but, they're actually starting to become more and more into the pipeline, depending upon if the borrower can qualify for them. Because USDA loans are a little bit different. It's the only other 100% financing option that's available, but it has to meet certain criteria. Okay, so for USDA loans, not only does the borrower have to qualify for, credit score wise, debt to income ratio wise, all those kinds of things, income wise, the property itself has to be approved. So anytime a client's like, Cliff, we were thinking about maybe doing a USDA loan, can you help us out and figure out what we need to do? I'm like, absolutely, Mr. and Mrs. Borrower. Let's kind of go over your situation. We know the credit score has to be, minimum credit score has to be over 640 or higher. And the back end debt ratio has to be under 43% or under. In certain cases, if it does go a little bit higher, and we say up to 45%, and we're still getting an automated approval in the system for them, they still have to have compensating factors, which means maybe high credit score, maybe extra reserves of some kind, and then a checking or a savings or an investment account, something like that. Those would be considered compensating factors that the USDA underwriting team would review just to see if they're able to go up to 45%, but that is definitely the max. So it's normally 640, under 43% debt ratio, you can qualify for that. But also the USDA has income qualifications too. So we have to go to the USDA's website as well. And depending upon the county, they'll let us know, hey, here's the max income that the borrower can, have in order to qualify for a USDA loan. And it's all strictly based on what their site says. But then most importantly, we put in the address of the property. So if a client is looking to purchase a property with a USDA loan, we get the address of the home that they possibly want to put an offer in, and we go right to the USDA site and see if it's even qualified. And I may even do, let me see if I can
Minimum acreage.
no, I don't believe so. I think it's like 30, maybe 30. maybe something like that. I know USDA loans, it's not necessarily an acreage thing. It just has to be considered in a rural area. They don't really, I don't think it's a big acreage, anything of that nature. Let me see if I can just kind of do a quick scenario just so we can. Let's see, just USDA. Maybe we'll go see if we can kind of do one here real quick. Let's see. Let's see if we can put in area. Some of these are easier to get to, but let me try this other one. Here we go. This is what I want. Nope, not that one. Here we go. Okay. All right. So what we want to do is when I'm looking for, we always want to click on single family. We hit accept. And we're looking for the property eligibility. So, all right, we'll just put in any kind of address. Let's see. I'll put in my address because I'm not, USDA, but at least it'll show that it's not. And then we can try to, if you guys have an address, we can check and see about putting one in too. Oh yeah, I was just, what's that address? 4612 Arrow AR. Road. Carrollton. Okay, 44615. See if I spelled Carrollton right. I hope I did. All right. Great example. Okay, guys. So now you can see, and everybody on Zoom should be able to see this. This particular address is a eligible area. So if someone's looking to buy this property, this would be considered in a USDA area. So, and that's what's nice. It's real easy to kind of get this figured out. You just go right to their site and put the information in, and it'll tell you yes or no. There's never an in between. It'll either be a yes or a no. So this was a great example for you guys to see what it would look like for USDA loans and how to check and see if it's a property that would be considered approval. So good information. I just wanted to do a quick, flash over to USDA site just so you guys can kind of see that. And this is stuff you can even go do on your own and check. Just go right to the USDA's website, go to the property eligibility tab. It'll pull up and you put in the address and hit go, and it'll tell you yes or no in case you wanted to do it. Yeah, what it'll tell us is what the USDA, at least this portion of it, property eligibility, and then we would focus over and go to income eligibility. So what we're going to do now, we'll say for this particular example, we're going to go, let me find Ohio. Okay. And we'll say Carroll County. Go back to the C's. There we go. Carroll County. Okay. All right, and we're going to put in a scenario. We're going to say we've got a 3-person household, number of residents under 18 years of age. We'll say 2. We'll say they got 2 kids or 1 child. Is loan applicant 68? No, we'll just keep it kind of basic. Okay. Okay. Annual child care expenses. We'll say they're in grade school, so we'll just say 0. And then, okay, and this is what they want on a monthly basis. So we'll say, dad brings in $5,000 a month. Mom brings in, we'll say $3,000 a month. Okay. Okay, and then we'll scroll all the way down. Rental income, any other income received by adult members of the household. Say no. All right, and I'll click finish. All right, so then I scroll down and it'll tell you if they meet the requirements. So, all right, so this says applicant meets the income limit. So I'm like, perfect, since I put in mom's and dad's income in there and combined, their annual income is 96,000. Okay, and then they take out 480 for deductions, you know, for the kids and stuff like that. And so in this particular area, 112,450 is the income amount that they have to be under, okay, for Carroll County and their situation. So 3-person household, income requirements, you know, for everybody that's working in the home. And in our case, this is just mom and dad because the kids in school. So they would meet the income limits to qualify for this particular property. So it's very simple to kind of go down. You know, it's good, you know, depending upon, I know how it's different with borrowers, how, you know, sometimes to me, they'll give you all their information. Normally they just give that kind of stuff to me, but this is what I would do. But if you say you're looking for family or friends or someone that feels comfortable telling you, hey, okay, this is what we make, you can help walk them through that. Okay. If not, I love it. And I'm more than happy to help them go through with us all. But yep. For this particular household, for like a 3-person household, the max would be 112,450.
Is there a way to reverse look up USDA like homes to know which ones qualify for that?
You know what? That's a good question. I don't think their model is set up that way. They just say, you know, they have their database, but it's hard to kind of just go through it and know what would be. So it's always about, if you got the address, just put it in and see.
But more rural.
But more rural, yes, yeah, for sure. For sure.
So on those loans is, the house itself, the appraised, or is the land value part of what you said that, the property has to come out?
Yeah. So what they'll do is, obviously the property and the lot that it sits on, if it's all together in one package, great. Then, you know, they'll try to find comps comparable, you know, say for instance, that's a house that's on 10 acres. Okay. So they're going to look at the property, and then if it's all together one lot, they'll then give them, you know, some value for the acreage as well. It's just when you get into separate parcels, that's when it becomes a little bit difficult. So we want to make sure that the house and the land is all together, that you know, we're using to qualify for it. If it's parceled off, they're only going to go off of the lot that the house is on. Then the other land will not be calculated into that value.
For some designated only for a maximum amount of acreage. I mean, not this one, but like conventional, you can only have so many.
Yeah, I think conventional, I think it's 10. Yeah, I think it's the max is 10. In some cases, we may have to go, you know, non-QM, which is non-conventional type of scenarios, to maybe allow for more. Or, you know, the only lenders that really would go over a crazy amount, it would be like a farm credit. That's just, and a bank or something, that's what they do. Yeah, but the standard regular banks, mortgage companies would probably just cap it at 10. If it was, not necessarily they won't do the loan, but say for instance, if they got a property that has 30 acres on it, they'll just probably count up to 10. You know what I mean? It's not like they maybe won't do it. It's just house plus 10 acres is what they're gonna probably base the appraisal on. It'll be in the notes for the appraisal, be like, hey, you know, base the appraised value off of that. So good information, guys. It's always good to try to hit these two, because I know USDA loans are not as frequent as the normal conventional FHA and VA loans. So it's nice to get a good understanding of these and just kind of check them out. Okay. All right. And then the benefits again for USDA loans, they don't have PMI, the monthly PMI, but what they do have is what they call a guarantee fee. So USDA loans, have an upfront guarantee fee, kind of similar to, VA, typically 1% of the loan amount, and an annual guarantee fee of 0.35% of the loan amount. So technically it's not PMI, but it's a monthly fee that goes into the payment. And they didn't used to have that. This has just been over the last few years. The USDA decided to implement this little monthly fee, but these fees are paid to the USDA to insure the loan and are typically included in the monthly mortgage payment. So I just wanted to make sure and kind of give you guys the information on that, what the fee is, who's benefiting from it, where does it go. This goes strictly to the USDA because they're basically insuring it.
Of the loan amount, right?
Yep, 1% of loan amount, not the purchase price. So whatever they're putting down if they want. Yeah, the 0.35% is guarantee is based on what is to get you the monthly fee. So that's 0.035 of the loan amount, and then you divide that by, I think it's by like 12 to get the monthly. Yep. So that's that. So just good information, good basic stuff on that. All right. Any other questions on the down payment amounts before we move over to the seller concessions? The seller concessions amount is really good, and it's going to be really important for you guys to learn and to structure deals. So everybody good? No questions on the down payment amounts? All right. Let's make sure there's nobody on Zoom that's got one. Okay. All right. Nope, nothing in the chat. Okay, guys. Now we're going to go to my new form here, the seller concessions cheat sheet. This is pretty awesome. And those that are on Zoom, I handed a copy to everybody that's in the class today, so they have one, but I can email you a copy of this just so you can kind of have it, and may even, put this in one of your buyer consultation sheets or, packets that you guys have. But this is good information that has all the different amounts of the seller concessions that are allowed. And then I'm going to give you another one that's on top of this, just because, it's good to know, and it's for like a little bit of a bonus. All right, so seller concessions, conventional, primary and second home, okay? If the borrower is putting down less than 10%, so you got to say you got a first-time home buyer, they're putting down 3 to 5%, or just any amount that's less than 10%, okay? The max seller concession on a conventional loan that buyer can receive from the seller is 3%. So that's very important to know when you're structuring, offers, and if the buyer needs, any type of concessions or financial help from the seller to make this deal work, we have to kind of factor that in. And that percentage, that 3%, this is all based on the purchase price, not the loan amount. It'll all be based on the purchase price. So you'll be able to figure that out quick. So if you're putting in an offer of, $100,000 for your borrower, and they're going to need 3% seller concessions, which is like $3,000. That way you can factor that in to your offer and say, hey, we're going to offer 103,000 because we're asking for 3,000 in seller concessions. Okay. Does that make sense? So just be kind of, mindful of that when you're helping your buyers if they need that particular help. Now, if they are putting a little bit more down, so if it's over 10%, between 10 and 25% down. So say you've got a client that's got a good amount of money and they're deciding, hey, we're going to put down, 20% down or 22% down or whatever the case may be. That then ticks up to a max seller contribution of 6%. Okay, so now the seller can pay up to 6% of the purchase price towards the borrower's closing costs, prepaids, discount points, whatever it may be. And then in the event you've got a client that's purchasing a conventional property, primary residence or second home, and they've got a good amount of money to put down, which is more than 25% down. Say they just sold their current house and they're applying all their equity towards a new one, they're putting 30% down. They can then potentially get up to 9% in max seller contributions, okay, and concessions. So that's good information to know. especially when if you're ever asked, or if the buyer for sure needs the money to kind of help. Now, back to conventional loans, though, on an investment property. So, which means the minimum amount down on an investment property is 15%. And that scenario is a single family residence only. And if they can qualify for it from a debt ratio, so that's the minimum amount they can put down is 15% on a investment property. It doesn't matter though if it's 15% down or if it's 30% down. The max seller concessions on a conventional transaction is 2%. So that's always important to know, 2%. Now, one of the other tidbits that I have on here that I wanted to mention that's not on this list is our non-QM program. I know a couple months back when I went over our non-QM types of products, like we have bank statement loans, we have our DCSR loans, which is all based on rental income. I'm going to probably do another class on that because these loans are really starting to get popular now that people are starting to understand them. I'm closing a DSCR loan here. I think what's today? Today's Thursday. We're closing it on Monday. The only qualifications that it took for this borrower was he had to show enough funds to cover, the reserve requirement and what he's putting down. I think he's putting 20% down. And this was no income docs whatsoever, no tax returns, no pay stubs, no W-2s, nothing. The income was solely based on the rent of the property. So once we got the appraisal in, I think our mortgage payment that we set up for him, the payment's going to be about $1,100 a month. The rent he's getting is like $1,300 a month. So we're using that rental income to qualify him for that particular program. No income docs. All we needed was asset docs. Done. It's literally that simple.
Right, that's not. I mean,
No.
They wouldn't even look at that.
Yeah.
Okay.
Yep. And so it's all based upon if it's if the property already has an active lease and a rent that's on there, we can use that. Or like my borrower's example, they have a home that they were buying and it was not occupied yet. So we got the rent schedule from the appraiser. We sent the appraisal out. The appraiser goes out there and appraises the property and includes the rent schedule for that. Like say, hey, this particular property can bring in based on the area. This property is going to bring in $1,300 a month in rent. And that's what we were strictly going off of.
So not even history on it.
No.
Just that, wow.
Yeah.
What kind of interest rate is that?
This particular rate for this particular bar was it was an 8.625, I think it was. So yeah, obviously, the rate and everything on it's higher, but he wouldn't have been able to qualify the traditional route. He had good credit score and had money, but wasn't showing enough income the traditional route. This was a solution and a way for him to get an investment property. He was ecstatic because I did one rental property purchase for him already, the standard way, but that was like his max. And then now he has 2 investment properties because we didn't even have to verify and use any of that income. All we did was the rental income. That was it. And as long as it was less than the payment. What's that? Yeah, credit score too. Credit score needs to be, I think for the program, that's got to be 680 or higher, I believe, for that particular property, for that particular loan for DCSR. But what I wanted to get back to is for the non-QM type of programs, if it's an investment property purchase, like my particular client was, the max seller concessions on non-QM loans is 6%. So that's pretty awesome. So we're not capped at 2% like, the conventional seller concessions limit is. The non-QM one is up to 6% because it's not QM. We don't have to conform to the conventional loan guidelines. So non-QM products, they can get up to 6% in seller concessions on investment properties as well. It's amazing. Okay. And then next we want to discuss FHA loans. I know you've probably seen this, probably a little more frequently, but FHA loans, it doesn't matter what they put down, 3.5% down, 5%, 10%, 20%, whatever it is, the max seller contribution will always be 6%. So that one's an easy one to remember. Okay. 6% is what, across the board, no matter what they put down. Very similar to VA loans. VA loans are a little bit different. They, depending upon if it's 100% financing or they're putting 20% down. Okay. The VA percentage amount in seller concession is 4% and up to 2% in discount points. They can probably, they can apply that as well. Like if say the borrower wanted to buy their rate down they can go up to 2%, or I'm sorry, up to 2 discount points, and that can be applied towards that 4%. So 4% is the max on VA loans. USDA loans now took the same route as FHA. So primary residents, these are all primary, they can go up to 6% in seller concessions to help with that. So that's another good benefit about a USDA loan is 100% financing, and they do allow for 6%. So potentially the buyer could maybe get into that particular property without any cash out of hand if they were able to work it out that way. So, but important information, good stuff to kind of know. All of this is, at your access. And if you ever have questions, you can call me. Use this as a resource just in case if you're in this kind of situations, because then you have it as your little cheat sheet. Yes. Yes.
But, in our market,
Uh-huh.
the sellers are no longer wanting to pay the buyer's agent commission.
Mm-hmm.
And these seller contributions
Mm-hmm.
apply to the buyers.
Absolutely.
Okay.
Absolutely can. Yep, that's a good question that she mentioned, guys. She mentioned, with buyers now, and that they're working with having you guys getting paid like hey, your commissions, buyers, how can they help pay for this if they don't have the money on their own? All these kinds of things, these seller concessions can help be covered by the seller. If it's not something that we don't have that they qualify for, like maybe a down payment assistance program, like our CCM Smart Start covers 2% of the purchase price. So, that would be something that could help cover your guys' commission. All those kinds of things. So if there's not anything that they qualify for, down payment wise, assistance wise, anything like that, these seller concessions can go right to cover your commission, the buyer broker commission.
Now, if the seller is covering part of it,
Mm-hmm.
say 2% or something. And
Yeah.
they ask for, is that buyer agent compensation still considered a seller contribution, or is it labeled something different?
It should be. That's a good question too. I think if that shouldn't fall in, if it's not labeled that, it shouldn't count in towards their concession amount, because if they're going to pay your commission, that's paying your commission. That should be separate. Yep. So yeah, no, good question. Yeah.
But that's a way you can
Mhm.
trick. But as a buyer agent, you can ask for the concessions. Don't have to tell the seller that's what it's being used for, but the buyer knows
Correct.
concessions are being. Okay.
Yep. We can apply it towards any part of that transaction that they see fit.
But it just can't exceed that percentage.
Correct. Yep. It just can't exceed that in the seller contribution because it goes strictly towards closing costs and prepaid items. And or, commissions. So good stuff. I wanted to make sure and go over all those, the down payment options, the seller concessions, amount that were allowed for each product. So now you guys have a good idea of what to expect, what is in store for buyers, and what they could potentially do. Any questions at all, feel free to, let me know. And I will send everybody that wants one of these a copy. Okay, Chrissy wants one. Okay, got it. Yep, I will send a copy to your email. So if you guys want one, just let me know. Call me, text me, put it in the chat. I will get you a copy of this cheat sheet. That way you have it and you can print it off and add it to your buyer broker packets or whatever you guys need to do, or just keep it as a reference. Okay, BB's I got you. I'll send you one.
Because I made notes on.
Oh, yeah, yep. Yep. Okay. All right. Yeah, no problem. All right, guys. Well, that is all I had for today. So any other questions, let me know. Enjoy your Thursday, and I will talk to everybody soon.
Thank you.
All right. See you guys. Thanks for joining in on Zoom. Enjoy the rest of your day too.
I like these Thursday things because they work in my schedule very good.
Oh, yeah. Yep. See ya.